All units, listen up. This is a full-scale market alarm. Stop scrolling. Stop staring at 5-minute candles. Stop arguing over RSI like it's going to save you. Because what I'm about to walk you through isn't a silver theory. It's not a cute chart pattern. It's not a Reddit rumor. It's a crisis narrative. One that, if even partially true, rewrites the meaning of safe haven forever. Switzerland, the global symbol of banking stability, has allegedly been forced into a countdown. And at the center of it is UBS, the same UBS that was supposed to be the final firewall after the Credit Suisse collapse. Here, as the headline claim, UBS is sitting on a catastrophic silver derivatives exposure, an alleged net short equal to 5.2 billion ounces. And the clock says they must slash it by February 10th. And inside that alleged emergency framework sits a price projection that sounds like science fiction, $298 per ounce. Not a hype target, not a YouTuber's dream. The claim is that it's a cold, risk-adjusted number from the very institution trying to escape the blast radius. So today, we're not doing fan fiction. We're doing structured analysis of the scenario being claimed, step by step. Why the math is impossible, why the psychology is dangerous, and why Switzerland's reputation gets dragged into the furnace no matter what happens next. Because if UBS, Switzerland's biggest banking pillar, has to sprint through a silver exit, then the question isn't, will silver spike? The question is, what breaks first? Goldman Sachs matters. HSBC matters. But UBS is different. UBS isn't simply a bank. It's the flagship of a national brand. Switzerland built a multi-century identity on 4 words: neutral, stable, discreet, secure. When the world panics, money parks itself in Swiss assets because the assumption is simple: Swiss banking doesn't do surprises. And yet, the entire premise of this story is a surprise so severe it would be historic. An alleged internal crisis assessment stating that a silver position threatens not only UBS, but the Swiss banking system itself. That's the doomsday angle. Because if a Swiss megabank is fighting a commodity derivatives bomb, then the myth of Switzerland as the world's financial bunker takes a direct hit, and it gets worse. UBS isn't some random participant in metals. UBS is one of the few pillars tied to London market functioning, one of the names that keeps liquidity alive. So if this story is even half real, it's not just UBS gets squeezed, it becomes a global credibility event. The claim begins with an urgent internal discovery: that the combined UBS plus legacy Credit Suisse silver exposure was wildly misreported, undercounted, or hidden across systems, until post-merger integration revealed the real number. The narrative says UBS believed it was managing something large but survivable, until system integration pulled back the curtain, and then suddenly the number isn't hundreds of millions of ounces, it's billions. This is where the story turns from bad trade to existential threat, because banks can survive losses. What they can take care to survive is losses that exceed capital and force an emergency unwind inside a deadline. And the deadline is the key weapon here. Because without time, the market doesn't negotiate. The market dictates. Let's translate the magnitude, because this is where most viewers lose the plot. The alleged net short is 5.2 billion ounces. Global mine supply per year is roughly under 1 billion ounces. That means the claim implies exposure, representing multiple years of global production. Now, the alleged central bank instruction isn't even close it all, it's reduce it fast. An 80% reduction by Feb 10, meaning roughly 4.2 billion ounces must be neutralized. Here's the impossible math: 4.2 billion ounces, 30 days, 140 million ounces per day. And because the story claims UBS must front load to show progress, the daily rate in the critical period rises to around 170 plus million ounces per day. Now ask yourself, does the silver market comfortably absorb a buyer forced to eat that much volume every day for a month? No, that's not buying. That's a forced migration through a doorway that's too small. And when a massive institution tries to escape through a tight exit, you get one outcome: price dislocation. If UBS has a crisis, Switzerland has a crisis, because Switzerland's safe haven status is a psychological contract with the world. It's not only about balance sheets, it's about belief. A Swiss megabank failing due to commodities exposure would trigger a dangerous question globally. If Switzerland can't manage risk, who can? In this scenario, the Swiss National Bank and the Swiss government aren't just observers. They're forced into the room, and the alleged logic is brutal. If UBS fails, confidence fractures. If confidence fractures, capital can flee. If capital flees, currency stability becomes harder. If the Swiss franc loses its untouchable aura, the national brand weakens. So Switzerland, according to this narrative, would rather force a controlled burn than allow a wildfire. That's why a forced exit becomes political, not just financial. The story pins the origin on the compressed takeover of Credit Suisse. In a rescue merger, speed is the priority, not perfect knowledge. The claim is that Credit Suisse had metals exposures spread across systems, desks, and structures, some visible, some invisible. And UBS in the rush accepted reported numbers as good enough, assuming risk was contained. Then, years later, as systems were unified, the unthinkable appears. A shadow book of exposure, positions that didn't flow cleanly into standard reporting. This is the nightmare scenario in banking M&A. You don't just acquire assets, you acquire ghosts. And if those ghosts are derivative obligations tied to a tight physical market, they don't disappear, they wait. Even a huge position can be managed if time is long enough. A multi-year unwind can be structured, it can be layered, it can be disguised through hedges and flows, but a 30-day forced schedule is a different species of event, because a deadline turns every counterparty into a predator. Think like a rival trader. If you know a giant must buy, you don't sell cheaply. You step back and let them chase. You raise the offer. You widen the spread. You demand premium settlement. And in metals especially, the moment panic hits, liquidity becomes performative, there on the screen, gone in reality. So the claim of $298 is less important than the mechanism, forced demand colliding with constrained supply. That collision is what creates vertical price behavior. This is where the story becomes structurally believable as a concept, even if the details are disputed, because physical silver is not an infinite pool. It's a chain, mine output. Refining transport inventory, deliverable bars, allocation settlement. When markets are calm, paper contracts settle and roll like normal. When markets are stressed, people stop trusting paper. They demand physical. They demand allocation. They demand delivery. And if a giant is forced to close, the market's response is, show me the metal. Now in this narrative, UBS cannot source enough physical silver in 30 days, not even close, so it must use a hybrid strategy. Buy physical, where possible offset paper positions, where possible cash settle, where counterparties allow defer obligations into long-term agreements, and every one of those steps has a cost. Cash settlement requires paying a premium because counterparties know you're trapped. Deferrals require paying even more because you're asking for time under duress. This becomes expensive fast, and it becomes reputationally lethal because the market will smell distress. The narrative says UBS's internal modeling lands on a base case number around $298, with a higher, severe case scenario above that. The reasoning is simple. Price must rise to a level where enough holders sell, or enough counterparties accept settlement terms, to let the unwind finish. In other words, the market doesn't ask what UBS wants. The market asks what price forces supply to appear. $298 in this storyline is the price that clears the emergency exit without triggering a total chain reaction. But even inside the narrative, there is a warning. If other shorts start to cover at the same time, if fear spreads, then the price doesn't stop at a neat number. It overshoots. That's how squeezes work. Not because they're logical, but because they're crowded. Here's something that's often true in real markets, even without conspiracy framing. When big institutions are trapped, they try to control sentiment. They push narratives that encourage selling. They fund research calling tops. They float overbought warnings. They emphasize volatility to shake weak hands. In this storyline, the claim is that UBS would benefit from retail and ETF holders selling because it creates liquidity and supply, either real metal or paper exposure they can buy back. So the warning message becomes, expect fear-based headlines, expect silver is topping calls, expect take profits now messaging, expect volatility designed to exhaust you. Whether or not UBS is truly in this position, the broader concept is accurate. Major players use narrative as a tool, because if you can't change the market, you try to change the minds inside the market. This is the most dramatic part of the entire storyline. Not silver, but Switzerland. The script's central thesis is that UBS E&S alleged silver emergency is a reputational crisis for Switzerland, because Switzerland's global role is built on trust and competence. If the world learns that the flagship bank inherited and carried a derivatives bomb for years, then due diligence looks fraudulent or incompetent. Risk controls look ceremonial. Regulators look asleep, the state looks cornered. And once that perception spreads, the country's safe haven premium gets questioned. And that premium is real. It's invisible, but it's powerful. It's what makes wealthy capital choose Switzerland even when yields are lower. Lose that premium, and you lose part of the national advantage. So in this narrative, the silver crisis isn't just a commodity spike, it's a branding collapse. If UBS had to cover aggressively, here's how the market would behave structurally. Price starts rising. Shorts feel pressure, margins rise, some cover early, volatility increases, weak hands exit, strong hands get louder. Premiums diverge. Physical prices start trading above paper prices. Spreads widen. Counterparties demand better terms. Cash settlement becomes expensive. delivery becomes harder, front-running becomes the sport. If other sovereign or institutional buyers suspect forced demand, they buy first. The market begins to gap. Because liquidity vanishes at critical moments, price jumps occur. And the key is this: the bigger the forced buyer, the more the market shifts from trading to positioning. The narrative also introduces the strategic buyer risk, that large state-linked entities may treat Western forced covering as an opportunity. Whether we name a country or not, the logic holds. If a major bank is forced to buy, strategic buyers can buy ahead of the flows, create a rising floor-reduced pullbacks, force the trapped buyer to pay more. In simple terms, if you're the forced buyer and someone with deep pockets decides to compete with you, you lose price control. And price control is the only thing that keeps a forced unwind from turning into an uncontrolled cascade. Now let's do the responsible part. What does this mean for you, the viewer? This kind of story can trigger emotional decisions, especially if you were already positioned in silver or mining stocks. So here's the clean framework. If forced covering happens, upside can be violent. If the story is exaggerated or false, volatility can still be violent, because attention itself moves markets. Either way, risk management matters more than predictions. Silver can spike and crash in the same week. It can print a moon candle and then rip your face off on the retrace. So if you're trading, you need rules. If you're investing, you need patience and position sizing. And if you're just watching, you need to separate entertainment from confirmation bias. Dates are fuel. Because a date turns a theory into a calendar event. People can anchor to it. Traders can build options around it. Media can schedule coverage around it. In the storyline, February 10th is the line. Exit by then, or central bank support changes, political action begins, and the market senses desperation. Even if you ignore every dramatic claim, the narrative structure is powerful. Here's the deadline. Here's the forced action. Here's the target price. Here's the national consequence. That is perfect viral architecture for a YouTube finance story, because it creates suspense, and suspense creates retention. So let's land this carefully. The most important idea in this entire script isn't the exact number, 5.2 billion ounces, or the exact target, $298. The most important idea is what happens when a systemically important institution becomes a forced participant. When a giant is forced to move fast, markets stop being markets. They become extraction machines. Everyone asks, how much can we take? And if Switzerland, the symbol of stability, has to publicly fight for control, then the safe haven story cracks, because safe havens aren't supposed to sprint. They're supposed to sit still while the world runs. So if UBS is truly trapped, then silver doesn't just reprice. And if the world starts re-rating Swiss credibility, then the shockwave isn't limited to metals. It spreads into currency assumptions, banking assumptions, and the global narrative of where money hides when things break. That's why this story matters. Not because it promises a magic number, but because it threatens an identity.